let's say you've got a service accommodation business, and how many properties do we have, Helen, in the service accommodation business?
4.
4 properties. And how much profit are they making every year?
Year.
Yeah, every year.
5,000.
Okay.
4. Which is the easiest one for you to work with?
I'll say nothing. Let's say you've made 100 grand profit, and this is a limited liability partnership. You've got to pay income tax, yeah, on those profits, yeah. In a limited company, you pay corporation tax. If you don't take the money out, which we've already established 10 odd minutes ago, you pay no income tax. In a limited liability partnership or a sole trader or a partnership, whether or not you take the money out, you've got to pay tax on the whole amount, which means you're going to pay 20%, or you've got your personal allowance, but on the rest you're going to pay 20%, 40%, so 20 is the basic rate, 40 is the higher rate, and 45 is the additional rate. So this is going to take you in here. So what you can do, if you're running service accommodation, is you can claim capital allowances, yeah? Most people who buy property miss out on capital allowances. So this is just to raise your awareness. When you're buying, when you're running service accommodation or you're buying commercial property, make sure you claim capital allowances. So in this particular building here, in this room here, what do you think might qualify as a capital allowance? To give you a clue. Thank you very much. Anything else? Lighting. Yeah, lighting. Toilet facilities. Yeah, kitchens. Fire alarms, that type of stuff. Radiators. Yep, so that type of stuff. There's quite a bit in there. So you claim capital allowances, and let's say you've got, how much did you buy the 4 properties for, Helen, altogether?
Altogether, 800.
£1 million, that's right. Okay. And we went to a capital allowance specialist, and how much of that qualified for capital allowances? Sorry? Okay, you don't know. So you went to a specialist. So we went to a specialist, and the specialist said 10%. 10%. Okay, fair enough. It's 100 grand. It's nice and round. So £100,000 of that is capital allowances. We then, when you buy property and you're turning it into service accommodation, you're going to most likely refurbish it. So we refurbish that particular property, Madge, and then how much of the refurbishment value qualified for capital allowances? You said that without moving your lips. What was the figure? Okay. You just got to give me a number for now.
All of it. 50.
Okay, all of it's not a number, by the way. Who said that? 100% not. Okay, but okay, you give me a hard number. Cash, money. 50,000. Okay. So you've got capital allowances on purchase, yeah. 100 grand. You've got £50,000 on refurbishment, yeah. So you've got 150 grand in capital allowances. You can write this 150 grand off against your profit here, which means you're going to pay less tax. Now let's just assume, because I want to keep the example really simple, let's assume in a year you made 100 grand profit, and in that year you've got 150 grand capital allowances which you can write off in one go. You would write off the 100,000 to make your profit 0, yeah, and now you've got £50,000 in allowances left to use in future years. Everybody with me so far? If you're not, raise your hand. You're with me, okay? Now the LLP's paid no tax. How much money is in the bank account? Okay. Do the partners have access to the 100 grand? So now they've taken out 100 grand if they want to. by paying no tax at all. Does that make sense?
Yeah.
So that's another benefit of a partnership or a limited liability partnership. If the same scenario exists in a limited company, the company makes 100 grand profit, writes up 100 grand worth of capital allowances, pays no corporation tax. If you take the money out, do you pay any tax?
Yes.
So it's not as good in a limited company as it is in a limited liability partnership or normal partnership. Okay? That's another reason for you. Now, at the moment, as the rules stand, you can write off up to £1 million worth of capital allowances in a year, which will end on the 31st of December this year. After that date, it goes back to 200 grand every single year. And that's called your annual investment allowance. It's in the book. You can write off right now £1 million after the end of December, 200 grand in any 1 year. So you could make 200 grand in profit, have 200 grand worth of capital allowances, write them off, pay no tax. And if you're buying more units, you're building up your capital allowance reserve, just like we were building up our reserve on our capital account on that £5 million for Mr. Smith. Does that make sense?
Yeah.
Everybody okay with that?